name is Dara Sharif. I'm a managing partner with Benchmark International, working out of the Tampa office in sunny Florida. Today, we're going to talk about what you need to know about selling your business to a strategic buyer. Before we get too far, though, I want to let you know there's two handouts. You can find them in your view. One is The Mark, which is our lovely publication we put together quarterly-ish, and the other is about Benchmark. So please feel free to download that. Why don't we just begin? You might hear a second person in the room. That's Sydney, who will tell me all the time when I screw up. So Sydney, thank you. All right, so let's go through a quick agenda, what we're going to try and cover here today. I'll reference a webinar I did, I'm going to say it's 2 years ago, on private equity buyers, right? So if you haven't gone through that, it's a must listen, must view. Go back and that might be helpful, juxtaposing those two kinds of buyer types after you've seen this one. So we'll do a quick recap of private equity buyers, financial buyers broadly, because it really is important to see sort of how they operate differently than a strategic buyer within the context of an M&A transaction. And I think what we'll do after that is we'll really talk about what is a strategic buyer. I think for us to contrast and compare, you really have to understand what makes a buyer strategic. Best way to do that is through examples. So we'll start conceptually, talking about what they sort of look like in the abstract, and then we'll go through, I think, 3 real examples. Hopefully you've heard of all 3 of them, certainly at least one. We'll go from there into due diligence, what it looks like, and how they approach diligence differently. We'll talk about how they structure deals differently, how they view that, and some of the comparisons and how you contrast those. Post-close, after a deal is done, how does the world look after? Very different. So we'll talk about that. That'll go seamlessly into why acquisitions fail more often than not, when they fail, the biggest reasons for that. And then we'll wrap it up. If you have any questions along the way, just reserve them. There's a dialog box for you to type them in, and I'll get to as many as I can at the end. Okay. All right, recapping that last webinar I referenced. So 2 broad categories of buyers, financial and strategic. Financial buyers are largely comprised of private equity funds. I'd say probably 75%, 80% of all buyers in the lower middle market are that are financial or private equity funds. But there are also family offices, venture funds, and independent sponsors. So let's kind of go back to private equity funds. So PE funds, they raise blind pools of capital. And the fund managers, the folks that sort of run the fund, are called general partners or GPs. They raise money from wealthy individuals, institutions, insurance companies, large endowments. They pool the capital. It's a blind fund because the investments are done afterwards, right? So if you're going to write a check as an LP, limited partner, you only know the track record of the fund managers, and you have a thesis. Here's what we want to do. Here's the markets we want to attack. Here's the timeline. Here are the size of our deals. Those kinds of things. So you're taking a bit of a gamble, and because of that gamble, you require a large return, typically in the 20+% range annualized, right? These are risky propositions. So over the 10-year life of the fund, you're looking for a 3 or 4x on your invested capital. VCs have a very similar model. It's very, very, very similar. They aggregate a pool of capital and deploy it over time. You have LPs and you have GPs. Independent sponsors are actually quite different. They raise money on a deal by deal basis. So they might find a deal they like and go out and try and put on their letter and then raise the capital afterwards. They might have some dedicated folks who have agreed to fund them. Sometimes they don't and pretend they do, but it's a very different approach. Now, family offices are very, very different. They tend to have folks who have had a career in private equity, so they're professional in that regard. But the money comes from one or maybe a few families, right? And because of that, because they have a real different mandate, they don't really have any defined hold periods, right? Private equity funds, and we'll get into that a little later, but the folks who are deploying the money have a real incentive to get that money out the door on the street and then back in the hands of their investors, because that's how they make their money. So they have very, very short in relation to family offices hold periods. Family offices might hold the business forever, right? They don't have that kind of a mandate. It's their money. They can do whatever they want. So it's a real different approach for sure. And they also tend to invest more often than not in businesses that they understand. And they tend to align with how they got wealthy in the first place. So think of someone who sold a manufacturer of inserts for your shoes, maybe Dr. Scholl's or something like that. They're more likely to invest in other orthopedic product manufacturers, distributors, things like that. So they don't tend to veer off. You won't see them doing software deals very often or other things that are not really aligned with how they sort of made it, right? Now, financial buyers, while they have a pure profit intent, right, they also tend to be pretty strategic. So they tend to invest in things that they've done a lot of work in. So they might have a thesis, they may have an operating partner, right? Someone who has sold the business in the same industry that they want to back, right? So they do have a view. They've spent a lot of time, maybe they have an investment already in this space, a platform investment, something that's similar, right, where you would fit in nicely and work nicely together. So they do tend to be strategic in their targeting especially. But the biggest difference between a financial buyer and a strategic buyer is that they've made the decision prior to writing a check to buy the company to sell it, because that's how they make their money. The end game is always to sell it, and to sell it for a lot more than they paid, right? So let's talk a bit about how they make money as fund managers, right? So they raise a pool of capital. The money is not theirs. They usually will have written a check, right? Because they have to show some skin in the game, but most of the money comes from LPs. LPs get their money back first, they get expenses back first, and then they get 80% of the upside, traditionally. So the fund manager gets 20%, and that can be pretty sizable. If if a $100 million fund turns into $400 million at the end of the day, they're going to make lots of money, right? Make lots of money. That's how they make their money. They make decent salaries, but they get rich by doing really, really well. So there's great alignment there. So they have a real incentive to have huge returns, but to sell, because if they don't sell, they don't make any money. So I would not expect a buy and hold strategy from any private equity fund, regardless of how long they say they'll hold on to it. They're going to sell it because that's how they make their money. So I think this is a natural place to pivot into a strategic buyer. What makes a buyer strategic? What makes them strategic is that they can extract value out of a business, out of an acquisition that's beyond the financial benefit, right? So something more than just the revenue and the earnings stream created by the acquisition. We'll get a lot deeper into that. You actually might be a strategic buyer. You may have already bought a business, right? And if you did buy a business, it's most likely something that's supportive of your existing business. That makes you a strategic buyer, right? A buyer who is strategic is an operating company, just another company in and around your industry. They're not professional buyers. They're just operating companies. Let's talk about some examples conceptually, right? We'll do conceptual and then we'll go into actual. The most logical is a competitor. They do the same exact thing, right? They understand what you do for a living. They really understand the market dynamics. Really easy to make that sell, but those don't tend to be particularly accretive, right? So think of a business that in a $1 billion market, maybe they have $30 million in revenue annually, right? That's 3% of the market. That's not a big player. Maybe it's a very fragmented market. Maybe there isn't a big player. Maybe you do 5. So you add those together and you go from 3% to 3.5%. Not really that accretive, right? So they're not going to overpay. So a competitor will usually pay sort of low market, or maybe be looking for a value play and pay below market. They don't pay premiums unless you're a nuisance. So if you just think of an example of a company that maybe they're 20% of the market, 5 years ago, and now they're at 12, and you were at 1%, now you're at 8, and going from 12 to 20 is pretty sizable. You're a much bigger player, a much bigger impact player in the market at 20% of the market, and especially given the dynamics of those two companies, one is growing dramatically, the other is fading. You're likely eating into their profitability, taking customers away. They are likely to overpay for you because it is strategic. one, you're fixing a problem for them. They can't seem to figure out a way to preserve their customers, and you're growing massively. So whatever strategy you're employing, they can employ it. Maybe a really good sales team or something about your products a little better, whatever it happens to be. They will likely overpay to take you out because you are a bit of a nuisance, and they might put in a takeout bid. So that's the one example where you might see them pay above market for sure. The other group that we see probably most often is folks that are within your value chain. Now, the idea of the value chain came up in a book by Michael Porter in the mid-'80s. I remember reading it in college, read it again in grad school a long time ago. And the notion of the value chain is really all those value-added steps that convert a raw material into a finished product in the hands of a customer and end user. All those little chinks that make that raw material into something people can use and will pay for. One great example, and it's very topical today, if you think about the automobile industry. I purchased some cars this year, and they're hard to get. You're buying cars from far away and having them shipped to you, because in this case there aren't chips. There weren't chips out there. And you know how cars are today. They're not typical mechanical processes that we used to see in old, in the 57 Bel Air. It's very different now. If an O2 sensor goes on a car now, it puts you in limp mode, and that's just how it works. So these chips are really, really critical. Think about GM. If they had in 2018 had decided, you know what, we're being held hostage by our supply chain, let's go and buy a chip fab, and let's do that in-house, just to mitigate that supply chain risk. I mean, they see into the future, they see what's going to happen, and let's not look into the sort of the labor part of that equation. But if they actually had access to chips, they'd be in a way different position than they are today, and certainly competitively against Ford and the others, they'd be in a real, a really good spot. So mitigating supply chain risk is a real reason to go and go out and buy a company. Now, the other piece of that puzzle is you're actually converting a cost into a revenue, if you think about it. So you're sending that money out the door to an external party. Let's just say it's $100 million a year, right, for chips. That's probably a 15 or 20% margin, right? 15 or 20 million dollars a year that you're of profit that you've created that for someone else. If you buy that business, now that profit flows to you. So there's a lot of reasons why that makes a ton of sense. Another example is a market disruptor, somebody who's sort of changing how your customer is addressed, how they're served. And an interesting one that I just thought of was Napster in the early, I'm dating myself, but in the late 90s. They sort of revolutionized how we as consumers consume music, right? They were a sharing service, but also you also pulled it really off the internet. It was early streaming. What if the record industry, rather than fighting it, and they fought it tooth and nail, leaned in and bought Napster for $20 million, whatever it would have been back then? We'd have a different world today. They were still printing CDs, right? They were fighting it, and they didn't see the future. They didn't, and they fought it in a different place today. But if they had bought that disruptor and pivoted their model, you would have an entirely different world today. Okay, a bit more. Buy versus build. That's a really interesting one, especially in a rapidly changing market. Software obviously comes to mind. It may be cheaper to buy your way into a market than to build, right? So if it's going to take you 18 months to build something, to build this solution that gains you access to a new market, an important market for you, that in a rapidly changing environment, you have built over the course of 18 months something that really addressed that market really artfully 18 months ago. Market's changed. The folks doing it now have been iterating over the course of that time. They have a solution now that addresses the current market, right? They probably have a feedback loop and a product roadmap, so they're addressing concerns from customers. And you're much better off in that kind of environment buying a business that gains you access to a new geography, a new customer segment, maybe a product or service, than you are building yourself. Think of we'll go away from software and talk about landscaping, right? Think about being a residential landscaper, and maybe you do $50,000 a month in revenue, right? So a nice little business. Maybe it's 500 houses that you've got to mow, right? At $100 a pop. That's a lot of work. That's hurting a lot of cats, you might be able to get 5 HOAs, right? And recreate that revenue with 5 relationships rather than 500, right? Maybe you want to attack that. It's hard, right? Hard to get Publix or one of the big grocery stores to say, hey, I'll have you do our work, or get one of the big HOAs at condominiums. Yeah, you can take our work. You haven't done it before, but we think you probably can. You're better off buying your way into that market, right? And that can be a game changer. Same thing with a new product or service. Building that from scratch is hard. It costs a lot of money. It takes a lot of time. You can actually, if you think about the opportunity cost of time, you're usually better off buying it than you are building it. And we'll talk about a company that does that a lot in the coming slides. I talk about the key a lot in this context. There's dormant value in every company. And a lot of times, because of size or scope or whatever, the seller doesn't have the key to that dormant value. The buyer might have that key. They can unlock value that you just simply cannot, and they'll pay more for it. Think about, you have products and services that play really nicely with theirs, but you just don't have a sales force. You can plug that sales force in and you might double your revenue within a couple of years just because of an infrastructure of sales that they have that you just don't have, right? Or it's cross-selling. Cross-selling opportunities may unlock value for both parties, right? So think of I'm going to make up a weird example, but a company that sells, golf clubs, and they're really, really good at irons, right? Mizuno is classic for their irons. They don't make putters, I don't think, and their drivers and 3-woods are terrible. So just think, maybe they buy Odyssey, makes putters, and they're already in the room selling to a big buyer. They're selling their irons. We can also sell you this putter. It's the best putter on the planet. We want to buy that too? Sure, right? So, and vice versa, right? So, you're selling your putter, and I also sell these irons now. It's great for the salespeople. They're incredibly incentivized. They can sell more product and push more product out, make more money. So, really unlocking dormant value there. And going back to sort of that conversion of a cost to a revenue, and that's an incredible opportunity. If you think about a classic example that I talk about a lot is an architecture firm, right? So think of a large architecture firm. They tend to manage the project, I'm talking about big scale projects, not a house, right? And they might send $30-40 million out the door every year to a structural engineering firm at a 15-20% margin. That's $6-8 million of profit they're sending out the door to another party. A buyer who has that structural engineer in-house, that's creative. You're manufacturing an extra $6-8 million a year. That gives you an opportunity to pay more because you immediately unlock value that this seller didn't have. They could not unlock because you had the key. Really important. Okay, so we talked about some of the conceptual examples, but most of us really like to see and touch actual examples, right? It's easier for us to process information if we can contextualize it. So one great one is Disney. So Disney bought Pixar in 2006. If you recall, Pixar was the brainchild of George Lucas of Star Wars and Indiana Jones, that whole series. They basically just recreated the animation market. They launched Toy Story, I think, in 1995. It was an incredible success. It still is. When Disney bought Pixar, they were marrying two really incredibly valuable pieces that became much more valuable together. Pixar's animation prowess and technology married together with Disney's incredible infrastructure in film making and distribution. They've been doing films since the 1930s. They had an infrastructure in place. Putting them together made too much sense. And it's been incredibly profitable. I think they've done over 20 billion in terms of box office since. 20 billion in box office. Think about all of the incremental revenue streams created from all these incredible films. Or you think about merchandising and all the rides at Disney that are really from Pixar movies. Put them together, it's been incredibly a creative form, right? One thing Disney did really, really well there, by the way, is they kept it a separate company. They kept the culture, the leadership, all the magic that made Pixar. They didn't destroy that. And it's been 16 years. It's been an incredible acquisition. Take a quick sip. The next is eBay. eBay and PayPal. This is 20 years ago. At that time, and I went back and looked, most of PayPal's revenue was directly a function of eBay transactions. eBay was allowing money to leave through a transaction that they created and go into someone else, right? If I recall, because I was buying on eBay in the late 90s, and if I recall, I bought a Harman Kardon surround sound system when I was in grad school in 1998. And I'm pretty sure I cut a check and mailed it off and hoped and prayed I was going to get that system. I did. It was great. Had it for years. That was the competitor back then, right? I think 70% of transactions had the ability to pay on PayPal in 2002. That's incredible. And I think something around a third of all transactions were paid at that point through PayPal. So eBay was creating this incredible value that was going out the door. Then when they bought it, they were capturing money that their customers were creating. It made too much sense. They sold it, I don't know, 12, 13 years later for 30 times what they paid for it. So incredibly accretive transaction, made too much sense at that time. And the last is Google. So Google in 2005, they bought Android. They didn't create Android. They don't really do that. That's not their strategy. At least it hasn't been for most of their life. They had a pretty dominant position in search at that point. We think about it being more recent. They're probably 90% of the search market now. They were close to 60%. I think it was 56.9% in 2005. Yahoo had about 21. Yahoo isn't really a thing anymore. But they saw the world evolving, right? Handhelds. That was where it was going. They bought Android for a song. I mean, $50 million in terms of that. It's a lot of money, but in the context of a Google acquisition and what it's done for them, it's been incredibly accretive for them. They converted that dominance in search, and now they've launched into all kinds of other markets. This is what Google does. I mean, they favor inorganic growth. They always have over organic growth. Organic growth is let's invest internally, let's deploy resources, R&D, people, money to attack a new market, right? And let's build it from scratch. They don't really do that very often. They tend to buy their way, and they bought Waze. They saw Waze as a real competitor, right? Kicking their tails in the mapping technology space, sort of the navigation space, and they bought Waze, and it's been incredible. I think most of us use Waze, even old guys like me. So that's what they do. They buy, they don't build. Okay, so the foundation is down. We've talked about strategics and how juxtaposed to a private equity financial buyer, how they look different. But let's get a little more specific, and we'll do that over the course of the next several slides. We'll talk about diligence. Diligence occurs once a company goes under letter of intent, buyer puts an offer out. Hopefully we help you negotiate a great deal for you. You sign a letter of intent, buyer signs a letter of intent, due diligence investigation commences. And that's when they really take a deep dive under the hood of the business. We'll talk about how that looks differently in a strategic deal versus a private equity deal. And also, and very importantly, how it looks post-close and some of the nuances in terms of deal structure, deal value, those kinds of things. Okay, so due diligence. One real advantage of selling to a private equity fund into a strategic is that they tend to be in and around your industry. They understand what makes you tick. They understand, if you look at a SWOT analysis, your strengths, your weaknesses, your opportunities, your threats, they're in that business for the most part. So they understand it. So what that does is it allows them, it allows them to really breeze through, in some cases, even sort of ignore the market diligence, right? So whereas a fund might do kind of a quick dive into the overall market and have a feel, but not a deep feel, these guys will know. So it creates more conviction, right? So if other things go wrong along the way, they're not going to be sort of scared away by something that comes up during their market diligence investigation, because they're going to know that already. So that's a real positive. If something comes up, we've seen this before, during diligence, like an environmental study, turns up some exposure. Someone who's in that industry, think of it again. We'll go back to landscaping. We had a deal in 2015 where some of the folks got a little sloppy when they're fueling their lawnmowers and it was a big company fueling their weed whackers, and they had some fuel spillage, and some of it seeped into the ground, and that triggered a phase 1 investigation, environmental study, and that said, hey, we have to do a phase 2. We did a phase 2, and they ultimately had to remediate. Most private equity funds would run and hide right? They do that very early in the diligence process. It comes up, red flag, gone, we're out. This buyer stayed in, they understood that problem, they understood the exposure and how to work around it, and how to mitigate it. So, that kind of conviction and that ability to sort of fend off these things that might scare off a financial buyer, it's also another real positive working with a strategic. Now, some of the downsides, especially the smaller ones. So these guys don't buy companies for a living. Again, they are an operating company. They do maybe what you do or something along the lines of what you do. Their day job is to run their company. This acquisition is a part of their growth strategy. It's not their day-to-day, right? So they most likely, especially in the lower middle market, they most likely will not have a dedicated team, a corporate development team. Larger strategics usually do, right? Especially these days. So those folks are, very well, very seasoned in doing deal work. A lot of them have come from either an investment bank like a Benchmark or from the buy side, working at a private equity fund. So, the larger businesses do tend to have corp dev, and that can be a little smoother. But especially if you're a $20 million company selling to a $100 million company, that they may not have a corp dev team. It's, in that case, it's super important you have somebody on your side representing, because the buyer will not be as professional. They will need guidance. They will need to be kept on track, because they may not have a really good feel for what it takes to get a deal done. So I really implore you to, especially in those cases, to hire somebody who knows what they're doing. We are certainly one of them. Okay. The other thing we see often is strategic buyers tackling functional diligence workflows internally. And we've seen this with the quality of earnings investigation, which is a real deep dive. It's almost like an audit. They go down to the general ledger level, look at 30, 40, 50, 100,000 lines of transactions, and they tie everything back. It's a way to sort of fortify and tie back the earnings stream to actual specific transactions in your general ledger. That's a deep dive. That requires a lot of repetition to be efficient and good at it. Even if you have really smart accountants on your team, you don't do enough deals to do it yourself. But some buyers will tackle it internally. You're better off, and private equity funds know this because they always do it. They hire accounting firms that have dedicated transaction support teams. All they do for a living is due diligence, quality of earnings. That's what they do. So sometimes you'll see strategic buyers tackling this stuff internally. It can slow you down. It raises red flags sometimes where they shouldn't be. They don't know how to process nuance because they don't have the repetition. So that could be a downside. We don't see it all the time, but it's much more likely when the deal is a strategic. And really importantly, because they don't do this for a living, they're going to have competing priorities, right? If something is really, really pressing, they're going to put the transaction down for a while, and they may not pick it back up. It has nothing to do with you, right? Because there could be something happening in the external environment related to their business that requires them to focus their attention internally rather than externally. That could be a real challenge. Okay, let's talk about some structural differences, and I'll take a quick sip here. You may have heard, because it's a well-known convention, that strategics will often pay a premium. And you might wonder why that is. I use 1 + 1 = 3 because they can justify a higher valuation. We talk about the key, right? Unlocking. You actually might have a key to unlock unaccessible value in their business, right? Maybe you can help them launch into a new geography, or you have IP that really can, on top of their platform, can be really, really valuable, or you can create some cost savings or launch a new customer segment, whatever it happens to be. They can justify a higher valuation because they actually do more with it. One more interesting piece is that funds don't tend to buy real estate. It's not part of their mandate. It's a different thing, owning real estate, and that's not what they do for a living. They really focus on, operating companies. It's not in their stated thesis, so they're more likely to not want to buy the real estate. They're more likely to want to do a long-term lease. If you want out, if you want to sell your business and the real estate with it, you don't want to have any future exposure, you might have to focus on a strategic, because they are more likely to buy the real estate. Think about a buyer that has reached capacity in their manufacturing plant. And one of the real strategic values that you create for them is that you've got tremendous capacity in your facility, and you're in a region that they want to be in, right? That they're going to want to own probably that facility, right? So that there's a real difference in the approach there for sure. They're also, interestingly, less likely to allow you to retain equity. So a lot of our clients, especially as they go deeper into a process, say, hey, this buyer really has a really good strategy at putting us together. I get it. I want to keep 20%. It's harder to get a strategic to allow you to retain a piece of equity, especially if they're going to fold your business in. Even if they operate it independently, they might fold it in sort of in terms of consolidating the financials and things like that. Makes it a little harder, a little clunkier to give you equity. If they operate it independently, they certainly can do it, and they may do it. But it can be clunkier, whereas a private equity fund often these days will require the ownership to maintain a piece, especially if you're staying on, or they'll equitize some of the senior managers that are staying on, because they really want conviction. They want skin in the game. They want people to act like owners, and the way you make people act like owners is you make them an owner. Okay? So, that's a real contrast there. So if you want to keep part of the business, you're going to want to look at strategics for sure. But again, you may not know what you want, right? The best way to go into this process is with an open mind and see what comes, right? So the best way to do that is to take it to market with someone who knows what they're doing and fielding offers from both strategics and financial buyers. And sometimes we can sort of Frankenstein a counter offer. You take pieces here, you take pieces there, and you get what you really want in terms of your end game. So deal structure differences. Continued. So debt, really big piece of a transaction for a private equity fund. Debt is a lever. That's what we call leverage. It's a lever. It lowers the amount of capital they've got to deploy, right? So we'll take round numbers, $100 million deal. Maybe they can get half of that in debt. They're only investing $50 million into the deal, maybe less if they can get you to take an earnout or a seller note, some other version of that. So the amount of money they've got to deploy is a lot less than the actual deal size, right? It also lowers the overall cost of capital. I said WACC, it's weighted average cost of capital. It's a technical term. The cost of debt is a lot cheaper than the cost of equity. So even in a rising interest rate environment, these folks can borrow money at single digits, say high single digits. The cost of equity for those folks is in the 20s, right? We talked about the IRR, the required return for these investors, the LPs. Do you want to sort of pay 20, 22% for the entire piece, or would you like to pay 8 for part of it and 22 for the other part, right? So they're going to favor more and more debt in the capital stack. It lowers the amount of money they've got to deploy. It lowers their overall cost of capital, and they can put more money to work. So that's a real, very few funds will go in and write full equity checks. They're going to try and lever it as much as possible. Strategics have a different view. They're not looking to sort of financially engineer a profit. They're looking to buy something that's going to make their business more valuable, right? They don't have their eye on the exit when they're buying it generally, right? Because they're looking at value creation. They also, especially if you're a smaller business and the buyer is a smaller business, they may be debt averse. We see it all the time. Privately owned companies often have leadership that just try to bootstrap their business, right? They fund growth through internal resources. They don't like debt. We see this all the time. So because of that, because they probably don't have a real access to banking relationships, it's hard for them to get it if they want it. Whereas a fund is going to do 6 or 8 deals a year perhaps, and fund all of them partially with debt and have a really good banking relationship. So for all those reasons, you will see a real difference in how they utilize debt, what the capital stack looks like. It also impacts due diligence and a lot of other things. So just one thing to keep in mind, especially if you're retaining equity, right? Because if the buyer puts debt on the balance sheet of the company they're buying, which is what they usually will do, that does change your rollover, right? And that's a deeper conversation, but that's why you need somebody who knows what they're doing, because a buyer putting debt on your balance sheet is not an equity infusion by them at all. They don't get credit for that, right? Because you're going to take maybe a 20% piece of that debt. So really important you have somebody who knows what they're doing. Last piece about structure. So we don't see as often strategic buyers using things like earnouts and seller notes. Those are conventions largely used by financial buyers. So we have seen them, they happen, but not nearly as often. They're much cleaner, typically cleaner deals, easier, simpler deals. So keep that in mind. If you're really averse to an earnout, a lot of sellers are, just keep that in mind when you're going through your offers. Hopefully many. Okay, so we talked about the diligence and the structure, and now we're going to talk a bit about post-close. Let's focus on the operational piece right now. So a financial buyer, because they don't operate in your market, even if they've got exposure to it, they don't work their day-to-day, they're much more likely to allow you and your team to continue running the business as it had, without a lot of interference. Their job really is to help drive value from the board level, right? They might have a lot of really good relationships. They might have a Rolodex that allows you to hire your first ever national sales manager, or put in a point of sale system, whatever it happens to be. They've got relationships, they've got vision, they've got capital, right? So they drive from the board level. They let you sort of run the day-to-day. You're on the board typically, or someone from your team is, so you're involved in that, but they don't dip below the operational line. A strategic acquirer might have a different view, right? Especially those that are in your industry or around your industry. They're going to have their own best practices. They're going to have their own way of doing things. They're more likely to have an opinion on how your business functions, who makes the decisions going forward. They're going to try to professionalize your business. They're going to add controls where you may not have them now, right? A lot of small businesses don't have controls in place. They have ad hoc processes. These guys might bring a lot more process. They might have a COO. That's the first time you've got a COO on your team. Now, funds add that as well. They add controls and processes, but they tend to be at the very top, not sort of in the day-to-day. They're much less involved in that day-to-day. So a real contrast between the two. Systems can be a real nightmare. Let's just say the buyer has Salesforce and you have either Microsoft Dynamics CRM or some industry-specific CRM. They may not play nicely together, and that integration can be a real challenge. And you're forced to say, hey, do we pick one, or do we Frankenstein this thing? Start taking parts off of each. But if you do, this new system may not align with this new vision, right? The reason why you put them together is because you have this long-term vision of what you can do together, these synergies that you're creating. You may not have the system that does that, right? So they have to be really thoughtful about that integration piece post-close. Systems is one of the biggest challenges post-close. The largest challenge post-close, though, is culture, right? And this is the reason why, more than anything, acquisitions can fail. So let's talk about what culture is. We hear about a lot, thrown around a ton. What is it? Well, it's really the shared values, policies, procedures of any business. Colloquially, it's our way of doing things, right? The shared values of the buyer and the seller could be completely different. Maybe we allow flexible hours, we don't. And the buyer is absolutely business hours. You're here from 8 to 5, 8 to 6, whatever it happens to be every day. Maybe work from home policy is different, especially in this environment. So many businesses do that, some don't. Business formal. I wear this every day, not this suit. I've got a few. We wear suits every day. We're rare. If we were to buy a business, we would make them wear suits. And not many folks, especially in Florida, wear suits every day. So that could be a real challenge, right? Leadership styles and infrastructure, right? Some decision-making hierarchy is really flat versus multi-level. Who makes decisions? Does it all flow up to the leadership and then back down? I hope not, but a lot of businesses still do that versus making decisions in real time, with the folks who have the most facts in front of them, right? A little more decentralized decision-making, operation. Those kinds of things can really impact an acquisition, post-close. Those different approaches, they haven't been tackled earlier. PTO. How much PTO do you get? If one is a week, the other is 4 weeks, you're gonna have some challenges. You're gonna have some challenges, or you're gonna have to make some real changes. We see this all the time, expense accounts for sales teams, right? a sophisticated sales team with really high flyers, you're going to expect, a lot more than sort of a lower level, small team. And putting those together can be a real challenge. We've seen this one too, customer problems. A customer calls, they've been a customer for 20 years with the seller. I've got a problem I need to fix right away. I know it's not going to make you a whole lot of money, but I really need this fixed. You might be of the mind to fix that regardless of what it costs you, how much time it takes you. Whereas the buyer might say, wait a second, this is a low value client. I know they've been there a long time. I'm not going to make any money on it. No, you can't. The opportunity cost of your time is too valuable. We're not going to do it. Those things can kill a business, right? The biggest threat, culture is the biggest threat to successful acquisition. How do you mitigate that? Well, this is change management. It's change management 101, right? You begin that process during due diligence and you put together a dedicated team. Hopefully the buyer has this as a part of their process. They've got a team with folks from both the buyer and the seller that are engaged in driving the integration and selling the leadership on these changes and having it trickle down and selling people, doing town hall meetings and all those kinds of things that are really, really important during the integration. But it has to start during due diligence. It has to start early and it has to be important. So natural segue into why these things fail. We talked about why they fail often. Sometimes it's the integration strategy, but a lot of times it's the execution. It doesn't have to just be the strategy because everyone has an integration strategy, but you have to focus on the execution. Sometimes the value of the synergy is off. Maybe they predicted it was going to create this much accretion, but it only creates this much, and that's a challenge. That doesn't happen as often, but it certainly can. But the execution piece is the most important part of it, right? So just because you have two companies that make sense together, you can't just put them together and hope it works out. You've got to have a plan in place. You have to deploy the resources to execute, to achieve those synergies. They don't happen by themselves. They don't happen in a vacuum. Sometimes they fail because of lack of conviction at the top. We see this a lot where you have a seller who actually is exiting the business, and he or she has a leadership team that's maybe younger but hasn't been equitized. They wanted to buy the business. They didn't get the opportunity because they couldn't afford it. They couldn't get the debt, whatever it happens to be. So the seller sells the business out from under them, as they say, and they don't have that level of conviction. They're not excited about this new regime. They'd much rather be the owners. That can trickle down to the rank and file. That can metastasize. It creates that contagion, and it can become a real challenge. You need that conviction from the top, and you need buy-in from the rest of the employee base. Sometimes having some of the key stakeholders focusing on the integration allows them to take their eyes off the ball. And their day job is to run a business, right? If they're not serving their customer base, if they're not creating new products, if they're not focused on growth other than the acquisition, that can really happen. We see that during due diligence a lot, where folks really focus on a deal, and maybe the deal doesn't happen, and the company now has a hole, a couple quarters out, because they haven't created the opportunity down the line. But again, culture is what makes these fail more than often if they do fail. In the phrase that we hear in the context of an M&A transaction that is emblematic of this issue is that's not how we do things around here, because that is what culture is, how you do things in a nutshell. And when that's the attitude, it's really hard to put two companies together, no matter how great the synergy is. If the cultures don't mix, and if it's not important, there's a high likelihood of failure. Okay, we've covered a lot of ground, so let's just do a quick summary here and put a little bow on it. So two primary classes of buyers, classifications of buyers. The financial, again, covered in a prior webinar. I encourage you to go back and find that on our website. And strategic, we covered strategic pretty in depth today. Those folks can be in your industry, somewhere in your supply chain distribution channel, somewhere else that can unlock some value. But these are fellow operating businesses. These are just folks just like you, maybe a little bigger, probably a little bigger, but have some of the same challenges you have. They can extract value out of the deal beyond the financial. That's how I view a strategic buyer. That's the most important determination for me. Can they extract some value that's not just the revenue created and the earnings created? Can you unlock some incremental value? Strategics, they bring, in terms of a deal, some real positives. they're going to really understand your industry. They're not going to require that being sold on the industry. They're already in it. They know it. They understand the challenges ahead, some of the tailwinds that are going to help along the way. They understand the macro environment, the micro environment. Because of this, they can pay a premium because they understand all these things and how they can plug into their own business. They really can justify it. Whereas a private equity fund probably can't justify paying above market, right? They also can breeze through that market diligence piece, which again can be a lengthy process. A lot of buyers will bring in outside folks to help with that. They could do that a lot faster, and they may just sort of do a cursory review of it. They also can get past some issues that come up in due diligence because they understand the actual impact of the issue. It might look like a glaring red flag to a financial buyer, and it may be not much of anything to a strategic. So little things that could scare away, a financial buyer likely will not for a strategic. And that piece about the real estate is pretty important. Again, a lot of our clients, if they own the real estate, they really want to, if they want to sell and they want to be out, they want to be completely out. And in that case, you're more likely to find a strategic buyer that's willing to buy the real estate as well. Now, if you find a better fit with a private equity fund, we certainly can facilitate a separate transaction that happens simultaneously and do a sale leaseback. So we can sort of work around that, but it does create some complexity for sure. Obviously, some challenges. We talked about some of the challenges of selling to a strategic. They don't tend to have a dedicated corp dev team, which really can make the process clunkier. It can sort of lack some conviction, and it tends to wander more aimlessly. Now, our job is to keep it on track, and we're quite good at that. But some deals don't have us, unfortunately, and they can take more time. And I've been known to say around here once or twice that time kills deals. So you want to have a real process in place. And without a corp dev team, it can seem a little less organized. So it's really important you have some organization on the sell side. And obviously, if you don't plan for it, manage it, and account for it, there can be some real impact and damaging impacts to the culture of both businesses, which is obviously not what you're looking for. Okay. So the best way to conclude is to talk about how you might want to look at the world when you're selling your business. The best thing you can do is just go in with an open mind and see what comes. If you've got a good advisor on the sell side, they're going to bring a number of different deals in front of you. We tend to bring 5 or 6 offers, sometimes many more, and typically from different buyer classifications. And what you can do is put them side by side. We'll put together a matrix for you, and you'll see some of the qualitative and the quantitative differences between the offers, right? Kind of a balanced scorecard approach. But being open to that and understanding the sort of the challenges and the benefits of all the different buyer types is the best way to achieve the perfect outcome. And the perfect outcome tends to be, hey, I've got a good chunk of change in my pocket. My business is in great hands. My employees are in great hands. My legacy as a great caretaker. And you can achieve all of those if you run an efficient process with open mind. And I think Benchmark is here to help you facilitate that, and look forward to working with you in the future. I'll conclude at this point and answer any questions you have.
All right, so we do have a lot of questions, so I'm going to kick off with them.
Okay.
The first question is, can you describe the differences in how a strategic and financial buyer look at a company before they make an offer?
Got it. Okay, so we touched on this a little bit, but we really focus more on the back end during diligence. So a strategic, let's just talk about the SIM, right? So the SIM is the story of the business that someone like Benchmark will put together. It's a confidential information memorandum. A financial buyer is more likely to look at the financial section, the history of the business as told by the financials. And it's really important. Everyone looks at them, but because they're so profit motivated, they have to be. They're going to spend more time on that part. So their questions are going to be largely a function of what happened with this line item over the course of these couple of years. I see the compounding annual growth rate for this was 12%, but here it was 18%. what's your growth story really look like? You know, is it a function of pulling cost out of the business that's not sustainable, or are you growing revenue? That's how they're going to be looking. That's usually the first blush. So the first set of questions we get from financial buyers often will be related to the financials. With the strategic, of course, you're looking at the financials. You have to. You got to adjust it. First of all, you're looking for how do I value this business? But more importantly, for those folks, they're looking at the story of the business and how that story dovetails with their own story. How do you solve a problem for them? So their questions are going to be much more strategic in nature, obviously, right? They're going to try to understand your origin story and what's happened over the last 4 or 5 years. If there's a lot of growth, they're not going to look at sort of just the numbers. They're going to try to understand why it's happening and can they plug that into their formula, right? So the questions on the front end, the way they're looking on the front end, they're just different lenses. And the strategic is going to look at the business, the sort of the operations of the business, some of the key sort of dynamics, the vision, what's got them to where they are today, where they're going to go in the next several years. Where a fund is going to focus a little more on the numbers.
Awesome. So the second question is, what are the differences between a stock purchase and an asset purchase?
Sure. And this one is really not necessarily related to any specific buyer type, right? Because we've seen buyers of all kinds favor a stock deal versus an asset deal. In a stock deal, they're literally buying the shares of the business from the shareholders. It's like you go on, online and buying IBM shares, right? So you now own the shares of the business. In an asset deal, the company is actually selling its assets. So, and usually it's all the assets, right? So it's not just selling a machine, but you're selling the business, but the business itself is selling its assets. And that entity now is likely an empty shell of a company. It still has ownership. The original shareholders still own that entity. And maybe there's, thousands of dollars left in cash in there just because that was what was agreed to. But what that means is if you're in an asset deal, you're not buying some of the past obligations, things that come up. It's less risky for a buyer to buy the assets of a business. With the stock deal, you're inheriting all of these contracts and all these other risks out there. So buyers will often favor an asset deal, one because of the risk piece, but also because it allows them to step up their basis, to reinflate assets that have been depreciated and then redepreciate them, right? So it's a non-cash item, but in terms of from a taxability perspective, it can cut their taxes pretty dramatically. To reinflate assets that have been depreciated can really make a big difference on cash flow because you're paying less in taxes. But there's also a similar difference to the seller, right? So how they're taxed is very different for the seller. So sellers tend to favor stock deals because of the favorable tax treatment as long-term capital gains versus asset deals. This is overly simplistic, but asset deals tend to be taxed at owner income, right? Very different, especially when you're talking about millions of dollars, right? And you have to figure in the basis that someone has in the stock in a stock deal, the basis someone has in the assets in an asset deal. It gets very complicated. I encourage you to, if you're at this point, engage someone who's an M&A tax expert. Usually that's an M&A tax lawyer. They're the best at this, better than CPAs, because CPAs don't tend to do a lot of M&A tax work, but it's really important that you do that. So there are a lot of reasons why buyers will favor an asset deal, why sellers will favor a stock deal. Sometimes a buyer has to do a stock deal because they need, a contract to survive. Maybe there's no change of control, but on the sale of an asset deal, it triggers something. So there might be a reason, maybe with government compliance or something along those lines. But more often than not, they want that step up in basis.
Awesome. So the third question is, please address the trends in private equity with the liquidity and the lowered tolerance for longer investment cycles. Is there a reversal in the growth of private equity?
So private equity has been pretty immune to these cycles, right? Because I spent about 10 years as a VC, a long time ago now, but you don't really mark to market these opportunities. So while you kind of do for your LPs along the way, you're riding these things out for 4, 5, 6 years. So these little cycles are not, they don't impact necessarily in the way that holding a stock might, right? Because if you have a stock portfolio with your, with your wealth manager, you might be looking at this portfolio every day or every week, and you're seeing this go up and down, up and down. That's not how funds do it. I mean, they really don't. The real time you mark to market any specific investment in a private equity portfolio is when you sell it. Or you do it when you buy it, and you do it when you sell it. You make estimates along the way. We bought it for 6 times EBITDA. We think now at this size we can sell it for 8 times EBITDA. We think it's worth about, but you don't know until you bring it to the market. So these little cycles don't impact them in that way like they would for sort of a public market portfolio. But the way it impacts them, this interest rate environment is, it's going in a direction where it should be. We've had artificially low interest rates for way too long, but that does impact the valuations, over time. We still have so much money in the hands of private equity funds. Is $2 trillion still of dry powder. So we're not seeing a lot of valuation issues yet in the lower middle market, but we will down the road in the next 12 months. We're going to see them. Now they're happening upstream, big time. But that's a little more expensive. So they requires they put a little more equity into deals. And that's a larger impact, I would say, than sort of the volatility, the duration of a private equity portfolio.
Awesome. And it looks like we have time for one more question.
Okay.
So the question is, how can a seller avoid earnouts and get as much as possible upfront? We spent years building the value of our businesses, and we really don't want to earn that value back. We should be paid what's accomplished, and an earnout to be building future win-wins.
I get it. I don't disagree with that at all. I think there's a couple things that I would usually respond to that with. One is, in that case, it's really important you have somebody on your side fighting, because earnouts are very useful tools. I think for a buyer, and I was on the buy side, they really do help me to consolidate my due diligence investigation. Like, okay, I think I'm bought in. Is the seller bought in? The seller really believes that we can do this together. Okay, let's put this earnout in place. Or is this business what I think it is? I've only looked at it for 90 days. The seller's been doing it for a long, long time. If he or she believes in this business and they can either preserve earnings or can grow it, then okay, then I believe it too. So there's more money at risk. But you could duplicate that with retained equity as well. That sort of seller conviction, for sure. So buyers use it for that. They also do it to stitch like additional value on top of the inherent value of the company today to reach like a stretch goal for a seller. So if a seller is looking for, a number that the buyer just can't quite get to, a good way to do that is say, hey, here's what the inherent value of the business is in our view today. To get to this incremental piece, it has to look different in a couple years. And for that business, 2 years from now, we would pay that higher number. So we'll put that money at risk from us and for you in the form of an earnout. So in that case, it makes a lot of sense. Like, we think it's worth 8 times now. You want 9.5. Let's put that incremental piece in an earnout. Now that might be maybe the first year is slight growth or meaningful growth, in the second year to your earnout is really a really big jump, right? And that's a way to bridge a gap between buyer and seller in terms of valuation. So there's nothing we can do necessarily to say we're just gonna get cash at close, because frankly, you might change your mind. I've seen it so many times where you put a buyer and seller together and there's just so much synergy in the room. They can feel it, that a buyer who wanted nothing but cash and didn't value anything else is now demanding a retained equity. And we've seen it because they buy in, and maybe the buyer has a real use for them that's not day to day, but perhaps on the board, perhaps as kind of that evangelist that's out there helping them acquire additional businesses, and it re-energizes the seller and they change their mind on structure. So there's if we go to market saying only cash at close deals, we're going to get a smaller number. I mean, you just are, and maybe you're comfortable with that, which is fine. We'll still extract the most value out of a deal than anyone in the market, but going in there with an open mind is the best way to achieve that. The last thing I would say is, if you can avoid showing the buyer any sort of pro forma sort of budgeted future financials, right? Here's our projections. Here's what we think we're going to do over the next 3 years. If you can avoid that, you're better off, because a buyer is going to say, oh yeah, you're going to grow 18% annually for the next 3 years. Wow, that's pretty good. That's almost double rule of 72, right? So they're going to stitch that into an earnout, and you might actually lose out. They might take away money from the inherent business and sort of add that money to the earnout, right? So the only time we've ever done that is when we needed a growth earnout, right? We were getting a great valuation and we actually needed more, right? Because the seller needed more than great. They needed incredible. So we would put together, in that case, again, I've only done it a few times in my 7.5 years here at Benchmark, put together some projections and got that last piece of value we needed based upon these projections. But I think key there, if you want to fight an earnout, make sure you've got someone fighting for you that knows what market is, knows that a cliff earnout is not how it's done. A cliff it's all or nothing. If you've got to hit 2 million in EBITDA in the first year and you're at $1.99 million, you get zero, that's wrong. There should be a floor. It should be ratable to the target, right? So if you get 80% of the way there, you get 80% of the money above a floor. You need people who understand what market is, and that's folks like Benchmark International. That's how you protect the value of your business. Hire a competent advisor.
All right. That looks like all the time for questions.
I went a little long, sorry. Well, I appreciate everyone coming out today. Look forward to doing my next one, probably in a couple of years. Maybe we'll focus on a different kind of buyer. We'll make this a 4-year series, but I appreciate the opportunity and thank you.